Bismillah Rahman Rahim. Welcome back once again. IFRS 15 is under discussion, and now it's time to explore step number 3. Before entering with step number 3, let's make a quick overview what we have done till now. Students, IFRS 15, the name is Revenue from Contract with Customer. We started the discussion with a point: if an entity wanted to report any transaction according to IFRS 15, so that transaction must have to meet the definition of revenue. That was the first point we covered. And of course, whatever the contract made with revenue the second party must be the customer, that's buyer. Contract must have commercial substance, all these things. So once, that discussion was about the scope of IFRS 15. What transaction under the scope of IFRS 15? So once any of the transaction enter with IFRS 15, then the discussion start with respect to steps. 5 steps need to follow for the revenue recognition. The first step was about identify the contract. With respect to identify the contract, there are 5 important points. The contract must be approved by the parties. Parties are seller and buyer. Number 2, each party must have to identify their rights and responsibilities. Payment terms of the contract is very much clear, very much identified. The contract must have commercial substance. That's the 4th point. And number 5, if the contract is made on the credit sales, so the seller at the time of contract, seller must have to make a system to assess the probability of the amount that's expected to collect. Any of the amount expected to collect in future must be probable at the contract date. That's 5 conditions must have to meet. That's called identify the contract. That's step number 1. After that, once step number 1, all the criteria meets with step number 1, then start the system of the revenue recognition. How? With step 2, identify the performance obligation. Identify the performance obligation. Performance obligation may be one, maybe more than one. So the statement is about performance obligation is a promise to transfer distinct goods and services. So if not distinct, that means performance obligation is one. If the performance obligations are distinct, and the distinct criteria, it's mentioned by very detailed, we have covered, it's mentioned by IFRS 15. Distinct must be with respect to seller, distinct must be with respect to the buyer, that means with respect to contract. After that, once identify the distinct performance obligation, the step 3 is to determine the transaction price. Do remember, with step 3, here we are not discussing about the price according to performance obligation. No, the total price of the contract. Determine the total price of the contract. You must have to recall the example of Jost, where the telecom company Jost has made a contract with Clary customer to provide the mobile set plus 3 promises. That's 3 promises about calls, services, SMS services, and mobile data services. Mobile data services. So 2 performance obligation, that's services, and the cell phone, that's goods. That's about goods. So The point is that with Jost example, if we refer the Jost example, here not a discussion about allocate the price. No. With step 3, determine the collective complete transaction price. Complete transaction price. So if you are going to draft your answer, transaction price is the amount of consideration in a contract, amount of complete consideration of contract which entity expects in exchange for satisfy performance obligation. No sales tax, no sales tax. So very simple, transaction price means consideration amount in a contract, total consideration amount in a contract. Here students, the critical point to cover here, that's the complexities here. There are 4 points. That's variable consideration, financing component, non-cash consideration, and amount payable to customer. So let's start the discussion with the variable consideration. So once again, with transaction price, one complications we are discussing here, that is variable consideration. Students, the transaction price between the seller and buyer in a contract, that's maybe fixed or the combination of fixed plus variable. Combination of fixed plus variable. For example, between seller and buyer, there's a contract. There's a contract to supply the goods. For example, the commitment between the seller and buyer is that seller must have to deliver 100,000 units of goods after 1 month. After 1 month is a time, 100,000 quantity, and also the description of the quality. Price is $50,000 plus if the delivery is according to the standard, according to the quantity and the time, or meets all 3 conditions, the additional bonus will provide by buyer to seller or seller will expect to receive of $5,000 as a bonus. So 50,000 is fixed. It's fixed. And 5,000 subject to the condition about the quantity, about the time, about the quality. So here we will cover the discussion either this variable transaction price, either we consider or incorporate with transaction price, yes or no. That's the discussion. So I hope it's very clear what is the issue about. This is the issue. But do remember, it's not always compulsory that variable consideration is something always about the addition. Maybe the point is that 50,000 is fixed and the time period is 1 month, 30 days. The contract is mentioned that seller will provide 50,000 units, for example, 100,000 units with the fixed price of $50,000 after 30 days. But if it's delay, for example, seller not able to meet the target of time period of 30 days, every extra day, buyer will penalize to seller $100 per day if not able to deliver by after 30 days. 1 day delay, the penalty amount $500. 2 day delays, $1,000. Then 3 days delays, $1,500, and so on. So this $100 per day deduction, that is also the variable consideration. So variable consideration is not only means something extra, maybe the deduction as well. But one common statement, variable consideration means that is not fixed but uncertain at contract date That's this particular variability or the pricing with variability may or may not happen. This is variable consideration. So I hope it's clear what is variable consideration. Here's the second point is that how to cover this point or how to cover the point of variable consideration with respect to transaction price. The issue is that at contract date, should we incorporate the variable consideration with the transaction price? This is an issue. And the answer definitely will deliver by accounting standard. Come on. So, the first thing is about variable consideration. Under IFRS 15, variable consideration refers to the portion of transaction price that depends on uncertain future events. Bonus, discount, rights, penalties, etc. What's the issue? Issue is, should variable consideration VC part of transaction price? We need to search the answer about this. Getting the point? That's the point. So here is the answer by the accounting standard. The entity must estimate the variable consideration and decide whether or not include in the transaction price. Include it in the transaction price. So where we stand now, students? We stand our position at contract date. And what's the discussion about? Should we incorporate the variable consideration with the transaction price? It depends on add or less. So first thing is that you need to decide. Number one. First we will cover the point that's decide. Then number two, estimate. First we will cover the point decide. Then decide means once we cover that point, okay, standard will provide support how to decide. Once we decide that yes, variable cost, variable consideration must be part of transaction price. Second point, how much? How to estimate? Because it's estimation. How to estimate? That's a point. So here, standard particularly mention that. Number one, decide. How to decide? How to decide? Here the statement. Variable consideration can only be included in the transaction price if it is highly probable that significant reversal of amount cumulative of the revenue recognized not occur when uncertainty is resolved. Means at the time of contract, the entity must have to decide either to incorporate the transaction variable consideration with the transaction price, yes or no. Yes or no. When become yes, when to incorporate the variable consideration with the transaction price. Standard says that when the entity highly probable, when the entity is highly probable that significant reversal of revenue recognized will not occur. In simple words, it is highly probable that seller will earn amount after all uncertainties are resolved. You don't need to think in this point. Sir, if we incorporate the variable consideration now and in future the things become reverse, ignore that point. Here it's all about estimation. Make it simple. Now at contract inception, when we incorporate when we incorporate the variable consideration, the term used decide. How to decide? Where the company, where entity assess with high probability that reversal of the cumulative recognized revenue will not occur. Means that if we enter with the variable price, the things will not reverse. Means, for example, if there are the chance of the bonus, we will get the bonus. Sir, how to estimate? Of course, having past experience. For example, these are the supportive points. Having past experience, maybe the past experience of the entity, maybe the organizational structure about the production, delivery, supplies, that is the confidence, maybe the market conditions, a lot of things. If the points are supportive at transaction contract rate, then the variable consideration become part of transaction price. That's a point. First thing is that if we are variable consideration to be based on future events like bonus, issue, can variable consideration part of transaction price at inception date? Two things, decide and estimate. With respect to decide, highly probable about not reversal of variable consideration in future. So once you become decide, the second point is estimate. Okay, first decide, okay, we are confident that the things will not reverse, we have to incorporate. The next point is estimate. How to estimate? There are 2 points with respect to estimate. Either probability, that means weighted average. If there are large population, or another point is single point. Single point means yes or no. Single point is yes or no. For example, if there are multiple chances of output, then we will use the probability for estimations. But if there are not multiple outputs, or there are not multiple outcomes, there are only the 2 chances, either one or either yes or no, then the single point. For example, with my case, if I referred an example in a manner, either you will be able to get bonus, yes or no. So outcome, bonus yes, outcome, bonus no. So no need about the probability. Where the probability is about, where the situation is about multiple outcomes may be possible. For example, if I say that, let's suppose, with reference to my example here, delays. 1 day delay, the penalty 100. 2 day delay, the penalty 200. 3 days delay, 300. 4 days, 5 days, 6, 7, 8, 9, 10. For example, there are 10 days possibilities. So then there are multiple outcomes. So if there are multiple outcomes, then we will use some probability method. So in simple words, variable price conditions based on some outcomes. If the outcomes, it's only about yes or no, then we will use the point of estimation as a single point. Either yes, either no. Estimate either to incorporate yes or no. If something about probability matters, if there is something about large outcomes, then we will use the probability. So this is what about the theoretical aspect. Let's make a discussion now. Now come on. Let's discuss with an example. You will, don't worry, you will get confidence about this point as well. Don't worry about it. For example, variable consideration. First example is about bonus. Example, 1st December X1, read it carefully. 1st December X1, Bristow provides a service to customer for next 12 months. The consideration is $12 million and an extra $3 million bonus. If after 12 months the number of mistakes made falls below certain threshold. 3 steps. Number 1, you need to pick that transaction price including some fixed component. This is fixed. This is fixed. And some components are variable. That's important. Some fixed, some variables. Number 2 point, if something about variable, this is variable. So second discussion point, either this 3 million should be part of transaction price or not. So for this discussion, first of all, we need to decide. And how to decide? About this 3 million bonus, entity need to assess either they will be able to get this bonus or chances of reversal is no. That means, okay, highly probable chances, that means they need to include with this 3 million with 12 million. Once they decide yes, then the question is estimate. Here the outcome of estimate about the variable, it's not something large population. It's simple about bonus yes, bonus no. So either no bonus, 0, yes bonus, 3 million, that's all. So this is the third point about the estimate. First, determine it's a bonus. That's variable. Then decide, then estimate. If it's variable, then go for decide. You are not confident with decide, leave it about estimate. Leave this bonus. Okay, now discuss the accounting treatment of the above in Bristow financial statement for the year end 31st December X1. If Bristow experience, now this is about some indicators, either incorporate the bonus yes or no. Bristow's experience to provide identical service in past and highly probable that number of mistake made will fall below the acceptable threshold. So having experience, that's their confidence. So that means with this experience, they are deciding yes, we will be able to get bonus. If this first the case is, now let's make a discussion. Number 1, the discussion is start with transaction price fixed is 12. 3 million is variable because it depends on some future conditions. That's a future condition on mistakes. Now they needs to decide and estimate. Estimation is very simple here. If they are going to decide, then estimation is simple. It could use as an expected value or most likely outcome. So there are only 2 outcomes, 0 or 3. So single outcome or most likely outcome, it's same thing. So most likely would be better predict the entitled consideration. Now they need to decide either to get the target or not. That's need evaluation. Case 1, that is the case 1. estimate has done. Okay, variable consideration need to decide. Bristow expect to hit targets. Expect to hit targets. Expect to hit targets. That means they are highly probable that if we add the variable consideration, that will not become reverse. So Bristow then decide whether to include estimate variable consideration in the TP transaction price. Based on past experience, it's highly probable that significant reversal revenue would not occur. This is decide. This is the point about decision. This is the point about decision. So decision, then estimate, they have already done. So the point is that this means transaction price 15 million. That's total 15 million. So yes, 3 million must be added with fixed price or the part of transaction price. That is the point. I hope it's very clear to all of you. Okay, the next case. The next case. Next case is about Bristow has no experience of providing service and unsure if the number of mistakes made fall below the threshold. Unsure. This is the case. So estimation is a secondary point. First thing is need to decide. Okay, decide. Whatever amount, variable consideration, whatever the estimation, variable consideration cannot be included in TP because Bristow has no experience of providing service and unsure if the number of mistakes made fall below the threshold. So it is not highly probable that significant reversal in the revenue would not occur. So therefore transaction price must be 12. So important point, it's decide, then estimate accordingly. Decide and estimate accordingly. That's the point. Okay, this is about the variable consideration. For example, one additional point I wanted to discuss here, it's not about the step 3. It's about the debt revenue recognition, but you can easily pick it. What is that point? If the 15 million, if the transaction price with 15 million, so how to recognize the revenue? Do you remember that? In this case, actually, 1st December 2001 was the date of contract. And our reporting date is 31st December X1. So that's about the 1 month game. So if the price is 15 million, so as a service, it is likely that performance obligation would be satisfied over time and the revenue recognized in the year end 31st December X1. Therefore, 15 million divided by 12. That's 1 month. That's 1.1225. 1.25 million. That's a basic one. And with respect to the revenue recognition of this 12 months, same performance obligation over the time, but the revenue recognition 12 divided by 1 over 12, that is 1 million. So this example is about a variable consideration, and you are now become able to get a basic about the variable consideration. So first thing is about bonus. If the contract includes a component of bonus, that's an example about the variable consideration. So we have now covered the rules about the variable consideration. Now it's time to discuss more thing about the variable consideration, because variable consideration is not only related only to the bonus. More things we can discuss here. Like here we covered the bonus. We need to cover something price concession or penalties. We need to consider refunds or right of returns. That's incentives, discounts, a lot of things. Now come on. For example, this one is the case. I strongly suggest pause the video and read this case carefully. Read this case carefully. Now we can cover with I'm sorry. Now we can cover the variable consideration point with another example. That's the price concession or penalties. Or other way around, I can say that if the contract includes some price concession or penalties, that's also called the variable consideration. So let's cover up. Yes. 1st July X8, Denmark Construction PLC signed a contract to build an extension to a retail outlet. Total price agreed is found 80 million sterling. The contract terms require completion by 31st March X9. Price will decrease by 200,000. Means this is something called penalties to seller or price concession. 200,000 for every day after this date that the project remain incomplete. So first of all, you need to pick that point. This price concession or penalties, penalization to seller is something about variable consideration. At the year end 31st December X8, Denmark expect that there is 80% chance of the project being completed on time. 10% chance of being completed a day late, 7% chance of being completed 2 days late, and 3% chance of being completed 3 days late. First thing is to pick price concession penalty as variable. Number 2, need to decide should we incorporate this variable concession with transaction price. So the answer is that here are multiple chances. 80% chance it's that project being completed on time, but remaining 20%, 10, 7, 3, remaining 20% chance of being delayed. So we cannot ignore this 20%. So yes, we have decided that this delays may happen and we need to incorporate with variable consideration. Now the third point is estimate. Here estimates, with respect to the estimate, there are multiple outcomes about with days wise. So it's not about any single outcome, or we cannot say here yes or no, but it's better to estimate with the probability. So you need to think in this manner. Okay. So what is the transaction price? First thing, the consideration is variable due to the fact that the seller, that's Denmark, will accept the amount that is less. That's different that 80 million, other than 80 million. Then the price is stated in the contract, that's 80 million, if the project overruns. And this complete statement is called price concession. You can say that price concession is about variable consideration, okay? Now, so need to incorporate this price concession. But what's the values? How to estimate? These are the values. That's 80% chance that we will get 80 million. That's 64 million. 10% chance is 79.8. 7% chance 79.6. 3% chance 79.4. These are the probabilities. So this will be the transaction price. Yes. The point is that yes, this variation must be part of the transaction price, number one. Number two, the second point, if this is the part, so how to estimate? By the probability estimation. So two examples we have covered till now. Now one more example I wanted to discuss here. One more example. In fact, two more examples, two more things. Now come on. That is about volume discount. Volume discount is also the point with respect to the variable consideration. Yes, read it carefully. Try to read it. Read it. First read it. Yes, Bellway has a contract to supply component to a customer on a monthly basis. Okay, seller has made a contract with supplier to the buyer, to the customer, that's deliver the goods on a monthly basis. Contract price $6 per unit and reduced to $5 per unit if customer orders more than 10,000 units during the calendar year. So try to understand the issue. That's a volume discount. It's a very norm in a retail business. It's a very norm. Okay, the contract has made for a certain quantity between buyer and seller, but seller provide incentify to the buyer that if your order cross with a certain quantity, we will provide you the discount. Like the case here, the normal selling price is $6. But if the total units exceed with 10,000, the price will drop with the $5. With the the price drops to $5. Number one, the customer ordered 1,200 units in a month of January. Bellway's significant experience that this product and purchasing pattern of this customer. Okay, significant experience about the purchasing pattern of customer. If 1,200 units is for the month of January, and if we exaggerate the figure for next 12 months, it's probable that this will exceed, the total order quantity will exceed with 10,000 units. So with respect to that, Bellway estimate that customer will purchase exceed 10,000 units and conclude that decide that it is highly probable that significant reversal of the amount recognized will not occur with the total amount purchased by the customer known at the year. So first at contract date, if Bellway is confident, so they first need to decide that it's highly probable that the units of orders is more than 10,000, then have to recognize the revenue or record the revenue based on the price of $5. So decide and estimates. Here estimation is about more than 10,000, less than 10,000. That's all. Number two, decide. It's about the assessment on the past experience. So explain how Bellway apply IFRS 15 when measuring the revenue of the January. So it's an example. Huh? It's example. For example, in this case, Bellway will recognize revenue 1,200 units multiplied by 5. That's 6,000 units. $6,000 for the goods sold in January. All agree, huh? As this is most likely outcome of the year for the year. If any time during the year, that's important, huh? That's another point, that the total number of units ordered for the year will be less than 10,000 for any condition, for any circumstances. So you need to make adjustment with retrospectively. Bellway should change the amount of revenue retrospectively. that reflect non-discounted price. That reflects non-discounted price. That's the point. That is the point. So I hope it's very much clear to you. Now one more and last example I wanted to discuss with you. If you have any problem, you can ask me on the WhatsApp. Don't worry. Now the next example. Very important example. Same with respect to the variable consideration. Students, once again, what we are discussing, step number 3, transaction price. And the transaction price, the complications. The first complication is about variable consideration. Variable consideration. And with respect to variable consideration, first we discuss the rules, then we are covering multiple examples. Okay, now variable consideration, that's called refunds and right of returns. Means seller sell the goods to the customer and also provide the rights, also give it the rights of returns as well. First of all, read it carefully with the example as well. Read it carefully. Please read it carefully. Now I'm going to discuss this point. Very important. So what is the case about? Listen carefully. Students, very important case. If a seller sell the goods and also give the rights to the return to the buyer. First of all, this right to return to the buyer is a consideration that's called variable. You need to consider that point. Whatever if the contract includes, listen carefully, if contract includes the right to return, that is considered, that is the variable consideration. That means the contract include variable consideration. So if this is the point of variable consideration, that then the point is about estimate the variable consideration and decide whether or not include the transaction price. Okay. So first, accept this reality that if the contract of the goods or the supplies of the goods as well as seller provides rights to the return to the buyer, this means the contract includes variable consideration. And here we need to decide and estimate about the variability matters. But the point is that which part of the contract we will consider as variable. This is important. For example, if you are a seller, you have sold 500 units to me and you say, based on your past experience, you have a mindset, but you are saying that, sir, out of 500, 40 units is expected to return. So here the variability is not about 40. The variability is about 460 units. That's a point. This is a point that's accounting standard is clarifying the point. The variable part of the consideration that need to decide is actually the part of sale not expected to return. Not expected to return. So very simple. Variable consideration means with the right of return, which part we consider that yes, the sales it's become confirmed, or I can say that variability means the chances the chances or the chances of the events or chances of the events occurrence which beyond the entity's control that may or may not happen. Yes, exactly. So here we need to consider that part of the sale. It's not expected to return. It's not expected to return. So we need to assess how much units become. If you are a seller and you have sold me 500 units, so you need to assess how much not expected to return. So that part of goods that's not expected to return, it's considered as variable. You need to assess that point, how much part not expected to return and part of my transaction price. This is important. This part I will read it after the discussion of this example. Now read the example. Nardone enters into 50 contracts with customer. Each contract includes sale of one product for 1000 units. The cost to Nardone for each product 400 units. Okay, cost is 400, sales price 1000. Cash is received upfront. You have received the cash, huh? And control of the product transfer on delivery. Controls already has transferred. Customer can return the product within 30 days to receive a full refund. Nardone can sell the returned product at a profit. Means customer can return the products and the seller, that's Nardone, will pick the product and then sell to the another customer. Nardone has significant experience in estimating returns of this product. Significant experience means that's the indicator about the decision and the estimation as well. With significant experience, it's estimated 48 products will not return. 48 will not return. How should the above transaction be accounted for? So here the point. The fact that customer can't return the product means consideration is variable. The first point is that. If the project includes the right of return belongs to the buyer, that means consideration is variable. The variable consideration is part of sales that is not expected to return. Here the not expected to return 48 units. That's important. I hope it's clear now. Any problem you can ask me. Nardone must estimate and decide about 48 units. So first, let's assume estimate. Using an expected value, the variable consideration is 48 product into 1000, that's 48,000. That's simple estimation, no probabilities. Either 48 units, yes or no. The variable consideration should be included in TP. By the way, first point is decide, then estimate. So with decide, why variable consideration should be included? Because seller highly probable that significant reversal in the revenue recognized will not occur. Significant reversal will not occur. Significant reversal will not occur. That is what the rule of IFRS 15. This is the rule. Decide. Highly probable. What highly probable? Highly probable that significant reversal of the revenue will not occur. Will not occur. That means 48 units will not reverse, will not return. And that is what the rule of accounting standard. The variable part, if you provide right of return, the variable part of that means decide is the part of sales not expected to return, not expected to return. That's a point. So I hope it's very clear to you that what part called here the variable consideration. Now students, next point. Same case with the next point. Sir, we have actually received the cash with 50 units. So what will be the accounting entry? Now listen carefully. Therefore, revenue, we have received 50,000. Huh? The revenue 48,000, bank debit 50,000. Revenue should be 48,000 and a refund liability of 2,000. That's expected to return should be recognized. So whatever we receive the cash of the 50 units, revenue should be recognized, match with cash, that's 48 units. But the remaining two, it's about the liability. NADON will de-recognize the inventory transfer to the customer, should recognize an 800 as a corresponding credit to cost of sales and right to recover from the customer settling the refund liability. Sir, what does that mean? For your understanding, for the clarification, I have made some transaction. Don't worry, the transaction with units, you can use the amounts. If the actual point is what should be the debit credit. Bank debit for 50 units, revenue credits for 48 units and liability for 2 units. But what should be the transaction with respect to the cost of sales? Cost of sales for 48 units. Inventory should be credited for 50 units. Why 50 units? Because instead of inventory, another asset will debit, that is right to recover from customer. That's 2 units. Other way, if I say that cost of sales debit, inventory credit for 48 units, okay. But here standard says that because inventory has already transferred to the buyer, so that's why all inventory should be credited. The inventory that's matched with the revenue, that's 48 units, should be charged to cost of sales, and remaining 2 units of the inventory should be transferred to the asset name right to recover from customer. So that is all about the variable consideration point. Here the last statement, note that once again, if the product is sold with the right to return, then the consideration is variable. So students, we have completed the point of variable consideration. Step number 3, transaction price, number 1. Number 2, with transaction price, the complication is about variable consideration, where the issue is about should the variable consideration part of transaction price at inception date. This will based on the rule about decision decide that the variability it's not expected to return if we incorporate now, and then put an estimation either probable with weighted average or with single outcome, that's yes or no. We have discussed multiple examples or situations here: volume discount, return base, concession, bonus. That's all about. So thank you for this part of the video. With the next video, step number 3 will continue with the next 3 points: financing component, non-cash consideration, amount payable to customer. Thank you very much. Take care a lot.